I mean, it's the same story. So as we continue to get rhetoric from the Fed, where it looks like we're going to be having some rate cuts coming up in the future, bond yields are under pressure, globally in particular, with negative yields in Germany and Japan. So the yield on the S&P and just the opportunity in the S&P continues to look attractive. The issue that we're seeing, though, is that until we get real clarity out of the trade wars and the things that are really going to materially move the markets, we're not going to be able to get a move up or down out of this range. So we continue to believe you have to trade the range. So as we're up here and you're seeing the Dow losing a little bit of steam into the close, I think it makes sense that you're going to see people looking to protect their portfolios a little bit. I still think 2750 to 2900 is a fair range to trade, and you really have to keep your eyes on the headlines.
Mike, but given since where we were this time last week, we've seen quite significant gains. What do you think are some of the factors that have driven that?
Well, heading into the beginning of last week, there was some evidence of quant unwinds in some systematic portfolios. So there's a lot of funny stuff going on with positioning on the back end, and we've seen some big moves in the factor baskets as well. I think at the end of the day, like I said, until you get real clarification on what the trade is going to look like, trade war is going to look like, you're not going to be able to have investors. Right now you have a lot of traders. When the market is dominated by traders, you tend to get a lot of whippy moves. So this last 6.5% move off the low has been more of a short covering, a reversion from the quant unwinds that we saw heading into the beginning of last week. And again, we're not seeing a ton of fundamental people moving and changing their portfolios because, quite frankly, they don't have the information they need to do that.
Mike Lewis, thanks for joining us.